This is our sell side panel. Dan Kelly from Market Access, Chad Wildman, FMS Bonds, Jeff Helwig, Millennial Advisors. Hi, Jeff. And Matt Smith from Spline Data. So here's something to get kicked off with. The corporate market is often referenced as a peek into the future for munis. Do you think that this rings true for munis? And if so, in what regard? Platforms, protocols, ETFs, other? Chad, why don't you?
I'll happily start off.
Had a feeling.
Here we go. There's plenty of overlap between the two in terms of when you boil it down to a fixed message, they look quite a bit alike between corporates and munis. However, I do think there are structural differences between the two markets that will be a permanent or at least semi-permanent roadblock to total sort of assimilation. Long only, and just the sheer difference in the number of issuers and distinct securities. You simply can't do some of the fun things that you can do with corporates and ETFs that you would want to. My short answer, because I'm keeping it short.
I mean, I'll add to that just because I think this is, sort of seeing a movie that has already been out, right? I do think that the municipal market has a long way to go. We're just getting started, right? And I think everybody in this room can agree we've come a long way in the last 4 to 5 years. I don't think we get anywhere near, 100% electronified, right? Because of all of these barriers or roadblocks that you say, Chad. But I do think that a portion of our market, which is, somewhat homogenous, right? It's AA, it's GO or REV, it's high grade. And the nature of our investor base, which was earlier mentioned, upwards of 45% individual investor, either it's in directly held investments or through ETFs or even mutual fund holdings, favors sort of an electronification in order to scale that business. So I think that, if you look at where corporate bonds are now, at least high grade, 45%-ish is what's assumed to be somewhat electronified. If you throw portfolio trading in there, it gets closer to 60 from time to time. And what are we at? 17%, 18%, depending on what you use as far as your addressable volume is concerned, your addressable market is concerned. I think we get close, and I think we catch up real darn quick. But I think that what is holding us back is somewhat structural, but what is pushing us forward is all the innovation that we've seen over the past couple of years from a lot of you in this room.
I'll jump in there. Yeah, we mentioned the prevalence of voice trading, certainly in larger transactions. That's still a predominant way that trading is done. And, coming back to just the sheer number of issuers, there can be plenty of bonds out there that look like the one you want, but if you're trying to get a unique name into your portfolio and there's only one dealer that has it, well, as far as the pricing goes, you're still going to see some of those wider markets that you're accustomed to in historical muni trading.
The pricing equation is fundamentally different. I think with some of the more liquid corporate names, you can almost hit it with a EWMA, make some bid asker on that. I'm not saying you'll make money, but you'll at least trade something with a tight cover. Munis are definitely a lot different in that aspect. You have to borrow information from different names, things that might be seemingly unrelated, but if you can figure out that relationship kind of mathematically, it works out. I think it's kind of a good thing that people think corporates and munis are similar. Like you see a lot of firms that trade predominantly corporates. They're like, oh, well, we trade corporates, let's trade munis, and vice versa. They find that it's a very different problem to solve. But I think the existence of more players in kind of a cross-asset world kind of makes sense because you get to at least play the basis between the two products. And I think a lot of the cues in pricing corporates like ETFs, they're very important there. I think they're becoming more relevant in the muni space. It's just how those are actually going to, make their way through the market is yet to be seen. It's going to take some experimentation.
It's coming.
Yeah. There's still, we've seen this growth in automation, but muni bonds are still a relationship-driven business. So where are you seeing the balancing act, or the often stated tipping point here between these relationships with counterparties? How have they changed? How has automation changed that?
I think Hector brought it up in one of the earlier panels, and I think it makes perfect sense, right? Where there has been a little bit of resistance is in the institutional block size. And again, I've only been at market access for 2 years. I was on the sell side for 1,000 years before that. And I think there is a perception that platforms like market access or ICE or TradeWeb or what have you favor smaller trades. And to a degree they do. And I think until such time that there is confidence in the ability to execute, we're going to be sort of held back. But I do not think that in any case, and I get in trouble at work all the time for this, that we become a market that is completely electronic. That relationship, that ability to source a bond, and that the uniqueness of the muni credit and the story that needs to be told, I think is going to be sort of complementary to the electronic process, which you can use to scale your business on a number of trades with smaller size.
Yeah, complementary. I think that's a good way of summarizing it. Is we're not going to become generic. I mean, we.
I hope not.
Yeah, no,
It would be, right?
I don't think it can be in a lot of ways, but then again, go ahead. Tell me I'm
I
wrong.
mean, yeah, no, I won't.
Good idea.
What ends up happening is that the buy side is becoming a little bit segmented on their side too. So it's that new relationships are emerging where, you know, me having only ever worked in the sort of high grade odd lot electronic space, I'll have relationships with the SMA groups at all of the major buy side firms. And I won't necessarily know some of the people that work in the institutional block size, but it's kind of a different set of people. And they potentially even have different technology implementations in place to solve for their workflow, which is, again, by its nature, high ticket volume and low average trade size. And so it kind of lines up. I don't know that segmentation is necessarily a good thing to get the overall market where it needs to be at the end, but that's, that's how it is. And so it very much still is a relationship driven business, but there are relationships for both the electronic piece and for the institutional piece.
Just building off of what's been said, there's so much that has changed, and at our firm, we kind of were able to bootstrap ourselves from the beginning without kind of the legacy, infrastructures that exist, in the buy side and certainly in the primary market. So we've been electronic first, and it's been great, but in a shrinking bid-ask environment, I think it's been mentioned a couple times, cash is a drag on your investment process. So actually building those relationships, not to maybe the extent it had been done in the past, but focusing on targeted conversations on what is most important and really like encoding that into our system on top of, whatever pricing we're using as a base has actually been really influential in leveraging that personal touch that does and probably will still always exist because, we talk about munis moving in days and weeks. If you're looking for highly sought after inventory for a variety of reasons, these things are moving in hours and minutes sometimes. And if you're not on the initial blast or, a message on Bloomberg because you're not having those conversations, you might miss out on it.
That's a super good point. I think it seems like the essence of the story, and I don't really have an axe here, but the essence of the story is like the nature of the relationship with the sell side and the buy side has changed from, what may have been traditionally, hey, read my runs that I send you on Bloomberg, to how can I like help you do your job better? How can I like create automation on your side if you're not able to get to it? Like, what can I do to make that easier for you? And I think that those are the dealers that are seeing a lot of success, is like the trading part they don't have to spend so much time on, so they can divert attention to their buy side to figure out how can I make you a better counterparty. It kind of reminds me of like, I worked at BMW for a very short stint, and they would send a team of German dudes in, and the German dudes would throw a bunch of money at automating their process so they could get tires faster. And I think it's kind of similar in the buy side, and I think there's a two-way flow there too, right? Like the buy side gives feedback. Quit showing me stuff like this. Quit buying stuff like this. This is not useful for me. So I think that's kind of the direction that relationships are going in the sell side.
I think I have to think about that a little bit more. But anyway, let's go into the next another question. Maybe I'll come back to that, because you were talking about throwing money at it, and one of the questions here is, how do you see strategy evolving in the market as it becomes more competitive? Is your focus going to be on better trading, better trading in the secondary? Are you considering expanding into other asset classes? Are there other segments of the muni market, such as new issuance? Well, how is this? How is all this technology and all this automation getting you to think about what what your next is, and what I've said your next is?
Yeah, as you continue to build and automate more, you can continue to build and automate more, and you get a good problem, which is, well, how do I decide to spend this time? New issue is definitely one that is being approached by sell side firms right now. ETF is also one that is becoming of interest. There's plenty of shops out there that have originated as ETF shops, but more traditional dealers are definitely starting to get into that space because it's really just, okay, you're taking, instead of one thing, you're taking many things. We have the data, we have the technology, and we can put a number on it.
I don't mean to hijack. ETFs are like probably my favorite thing about financial markets in general. They're just very cool. Like the arbitrage component is very interesting to me. Similar to like the conversations that you guys are having with the buy side, I think that same conversation needs to be had with the issuers to say, take bonds instead of cash. Let us do the work for you. Let us find the bonds for you. Let us, help you do your job. A lot of ETFs in the muni market are cash, or they have kind of like arbitrary creation redemption rules. And I think that becomes more standardized. You're going to see a lot of assets shift in that direction because dealers are pushing the assets in that direction. And they're going to be more inextricably linked to muni valuations, which makes me happy because I can use another data set to try and improve our pricing product.
Yeah, I think from our perspective, and that's a very subjective question that you asked, right?
Yeah.
We're agnostic, right? As far as the goal of where we're going to invest going forward, we want to have the tools that people want to use, the protocols that people will use to be more efficient. And from our perspective, we're indifferent as to which protocol or which tool. We're just looking to own the order, for lack of a better term. So, that's completely different from what you guys are looking at, just given the fact that we have different, roles in the market. But that's sort of kind of, where I think the market is going, where you're going to have not the haves and the have-nots, but you're going to have different tools at different places that will cater to different types of investors. And that's probably what you see, at least in the near term, the next 18 to 24 months.
But to some extent, you guys are doing that, at least on the corporate side. I remember right before I left Headlands, there was like you were doing some deal with State Street where you had like, two-sided quotes on ETF eligible QSIPs. Like, is that something that's possible?
Well, I'm like you. I don't have many hobbies, but I love ETFs. No, but I did ETFs back in 2011 and 12 at my prior firm, and I thought it was one of the most interesting parts of the muni market, right? Even though it's long only, and even though it's extraordinarily difficult back then, maybe it's different now to be able to borrow shares and express an adversarial position. I loved the create and redeem process. It was unbelievably time intensive, unbelievably laborious and frustrating. But I think that, ETFs, as they continue to grow and frankly, as they, sort of expand in the media market, not only the number of ETFs, but the number of sponsors, okay, or managers, I do think there's a need for, whether it's a platform or what have you, a forum to better efficiently match baskets with cash or, in-kind redemptions or whatever you want to call it. And that's something we're certainly looking at.
Okay.
Yeah, that actually, you've jumped the gun. And the next question is, how has ETF growth, the MUB, the VTEB, become relevant to your strategy in muni sales and trading?
Yeah, I mean, I spent a lot of time on this at my former employer.
Our former employer.
We worked together?
Yeah.
Oh, yeah. I thought you looked familiar. It's a very different beast than an equity ETF. Like with an S&P 500 ETF, there's just no question. You take the shares, you take the ETF shares, you get the stocks, and if you're an authorized participant, there's no problem. There is a big, or was a big, maybe those walls are being broken down, but there was a big impediment to doing that in the muni space. Again, because of the long only, but also just because of what Matt alluded to a moment ago. There were really onerous restrictions from a lot of the issuers in the top 5 ETFs that prevents you from really just kind of, even if you are an authorized participant, doing that when you want to. You do it when they want to. Well, might not be really ever. That being said, I do think that the idea of having a centralized pricing engine, like a muni pricing engine that can price not only just muni bonds, but also, integrate across all of these different things like ETFs or derivatives or whatever index TRS, whatever you want to look at, is really powerful. And I think a lot of people are focused on that. It is very cool. I would love to see a little bit more of a lower barrier to entry into that ETF space, so that more people can start doing it and make it start at least approaching the efficiency that you see like in the equity or even the corporate space. But again, some of the structural differences between the markets can make that challenging.
Jeff, any thoughts on this?
Yeah, just in thinking about, from a high level, where we're at in ETF. I mean, tremendous growth in the muni product in the last several years. But, in raw data in terms of AUM in the last year and, just dealer activity, purchasing bonds in the marketplace, 8 to 10% of index eligible bonds are ending up in an ETF. And if you compare that to equities, at least those owned in the U.S., that number, or that percentage is probably closer to 18 or 20%. So there's there's a doubling there, at least from the data. Not to mention the overall trend. But even now, on a day-to-day basis, we have to look at these individual CUSIPs and think about how they influence these baskets. And it is we can absolutely quantifiably see how discounts and premiums in the ETF are in real time affecting where dealers are willing to source this inventory.
So it flows into the next question here about automation, and it asks, as the market and its participants have become more automated, what has come up for you is either challenges for your firm or, hey, these are really great opportunities and we're going to take it, where we can pursue this even further to expand what we're doing now.
If I can start with some of
Yeah,
my
please.
observations from talking to firms that like want to get into this space, the predominant barrier to entry is just cost. There are so many data sources that you need. There's so many, technology stacks that you need, and so it's not something you can just kind of like, dip your toes into. You kind of have to commit the resources to it. So I think like visualizing what an automated strategy looks like, or what, and it doesn't even have to be fully automated. I always default to that, but even just being like a tech assisted trader, having a better idea of like what that looks like from a P&L standpoint, because that's what drives sell side decisions for the most part. Having conversations like these, I think, is helpful because you can see all of these successful people in like very diverse form too. Chad's like a one-man show, which I still find really incredible, and maybe he's going to hire a bunch of people. I don't know. Millennium is like, it has a pretty interesting evolution. Like I would say not too long ago that you guys were mostly traders, and there's definitely been like a bigger tech shift recently. Maybe I'm wrong about that, but
No, you're right. You have to have knowledge of how financial markets work, that fundamental understanding, but it's almost impossible to be effective in this space now unless you have some kind of tech stack behind you. So, I mean, the role of the trader is changing, and embracing that is easy within a culture, but still, it's a matter of multitasking, really. And I guess, again, kudos to Chad doing it the way he does. But yeah, there's been a pretty quick change for us for sure, and it's it's still a challenge, but it's one that we're happy to engage.
Yeah, but I also think that there's also a lot of unknown, right? Again, talk about me because that's what I do. But when these vendors would come into our prior firm, right, I would pretend to be on the phone, right? Because I didn't know what to ask, I didn't know what to look for, and I didn't know what the benefit would have been. I was a little bit intimidated by it, right? And I look at automation or technology or whatever you want to call it as such an enhancement to what a trader does on a daily basis. You can do so much more in the same amount of time now than you could have done a couple of years ago if you are leaning on these resources that are available to you. And I think that's allowed for businesses to scale. That's allowed you to do what you're doing now, right, without having 15 people on your payroll. And I think that that's been one of the major benefits of sort of the evolution of the muni market is the ability to scale and the ability to have smarter, more efficient conversations with your counterparties without having to worry about, okay, well, MMD is here and my spread is here, where it just comes out to, being able to do more in the same amount of time.
I think it comes down to that the sell side workflow, if you focus in on, a simple space, like again, high grade bots, where there's the most electronification in the muni market, it's relatively straightforward. No matter what shop you work at, there's going to be maybe some differences, but there's kind of a finite list of protocols and things that you need to be able to do and automate to have a 100% automated book. But the client base is the complete opposite. There's still just a huge diversity of how different buy-side firms are going about doing their respective automations. And as a dealer, if you want to, have good market share or have a good relationship or trade with those counterparties, you have to satisfy everyone. And so that's where kind of the challenge lies. It's relatively easy to automate the sell side trader workflow, but to make it fit with what every counterparty might be doing on the buy side, it's whack-a-mole. They're not ever really going to all do the same thing, so you got to take them one at a time.
So you're saying there's an opportunity.
I'm saying there's an opportunity.
I think we've danced around, the concept here about, leaning into our client base and finding out how we can be a partner in liquidity. I think that kind of
Exactly.
sums it up.
Exactly.
Yeah, partner in liquidity. I think
Rather
that
than
does
just a
sum
bunch
it
of
up.
sharks.
Yeah, well, let's stick with the partner in liquidity. Let's do that. It's interesting. I had a friend of mine started with Oracle a long time ago and rose up to be the head of internal sales there, global head of internal sales. And I said to her at one point, I said, geez, how does it work when you're selling this kind of technology or you're selling very technical things? And she says, I never sell. And I'm like, all right, enough. How does it work? She goes, no, genuinely, I don't. She goes, when you're dealing with technology, you're not selling, you're a consultant. You're solving a problem for your ultimate client, and you're trying to find what solution works best for your ultimate client. So you're not actually selling them anything. You're working with them to find that solution, and through that's how you're writing the contract, and that's how you're generating. And that sounds an awful lot like we're doing here as the technology begins to transform the muni market. From the sell side is with those counterparties, you're looking for how can my technology work with the whack-a-mole, with these different things? What opportunity exists to make that more consistent, as opposed to, hey, I've got a bond and it's spread off of MMD, and what do you think about this? Which is I think a form of automation as well, right?
You can't say MMD on this panel.
I'm sorry.
You have to say spline.
What did I say? Spline, right? Didn't I say spline? You all heard me say spline,
That's what he
right?
said.
Right.
I know. Can't bring
All
you
right. Can't bring you anywhere. All right. Final question, I think. Generative AI has become, and Matt told me I'm supposed to save this for last. I only get one shot.
Well, I was hoping you would get the audience questions first.
Oh, okay. I'm taking a hit from the host.
The AI answer the questions.
Yeah.
That's ChatGPT.
Flying GPT is going to answer the question.
Let's see. We're not seeing any new questions yet, so we are going to have to go to this one. Sorry. With that.
Oh, there's 2 questions.
There's 2. Oh, there are. Look at this. It popped. Thank you. Thank you, audience, by the way. There seems to be overweighted focus on secondary pricing. When will the primary market experience the same pricing hype?
Boy, if there's one common theme over 3 of these panels, it's been what's wrong with the primary market, right?
Yes.
Why is everybody afraid to touch it? And believe me, that we can have that conversation over a beer or two later. But I agree. I think that, it's been pointed out in, various panels prior and even panels elsewhere that there's inefficiencies in the primary market. Now, I used to be an underwriter, so I have a really strong opinion about this that I will not bore anybody with. But yeah, I think it was Megan Kilgore who said, like, she is the CFO of Columbus, Ohio, AAA monster issuer, but she advises all these small little towns and cities around America who they could be superintendents, they could be doing payroll, and there's inefficiencies there because maybe it's lack of access to information. And it's not just information. Everybody has access to, whatever, some data, but I think it's usable and actually actionable data. And whether that's using an advisor to funnel that information to any particular issuer, or whether that's using an underwriter, but I do think that there's an opportunity and almost a missed opportunity with respect to the amount of data that's out there, right? The tools that Spline and others provide that can make these issuers a lot smarter. Right? Like there's no, I'll stop in a second, but there's no more frustrating experience as a former underwriter of working your tail off to price a deal, and then all of a sudden the issuer's like looking at you like, I don't know what this means. Whereas you think it's a pretty good deal, you're giving them all this context. If they are armed with that information prior to going into the market, I think that makes that transaction a lot smoother from the sell side, from the buy side, and actually to the issuer themselves. Done.
Good. That was good.
How's that?
I can chip in here.
Please.
I think this was a layup for me from one of our employees, but I got two things to say. First, if any issuer here or small issuer is watching and post, reach out to us. We will give you our AAA curve for free. We will price your bonds for free. I think Megan said that, right? That it's hard for them to get access to this information. That should be totally free for issuers. We should be making it so easy for them to issue bonds because we need that to survive and we need them to trade. And ideally, Chicago can issue some bonds and fix all the potholes near my house. The second portion of this is we're building in a similar fashion to our secondary pricing model, a model that can price bonds that don't exist. So to give an issuer, an MA, an underwriter, you name it, an idea of where bonds might come to market will hopefully make that process a lot more efficient and hopefully make the sales cycle for that a lot more efficient, because rather than have to go back to the desk 100 times over to see what it would look like with a 9-year call, with an 11-year call, with a 10.5-year call, with a 10-year call, with a 4% coupon, they can have all of that in front of them and kind of do it all at once. And then the underwriter still has a role in that model where they can contribute, their perceived idea of spreads, whether that's due to market conditions or whether that's due to our model being slightly off, who knows. So I think you're probably going to see, we're probably not going to be the only company to do this, but I think that that's the direction that at least pricing is going in the muni market.
Brokers are not represented here. How do you think they are adapting to all the tech market pressures that potentially are squeezing them?
Looking for jobs at car dealerships?
Well, the BMW places a hiring. So Market Access owns Muni Brokers, and I do think that they are slowly embracing, the changing market. That said, a broker's broker, from my experience, is driven by voice trading. That they're giving information out to whichever counterparty, whether it's on markets they have, on bonds they've seen, and they're brokering trades between the two. We are seeing them embrace, sort of a more forward-looking workflow. But I think at the end of the day, that may come back to that whole complementary relationship between technology and voice trading, where they are, really communicating to whomever their clients are, what they're seeing, and providing perspective, which is something that, although you may have predictive pricing engines, that platforms and or electronic venues cannot provide.
Another question comes up to Chad's point about the buy side still being fragmented in their trading approaches. What are tech-enabled buy side firms doing differently to gain an edge?
Yeah, I mean it depends on the nature of the of the buy side firm. I mean, again, many buy side firms have kind of a group that does funds, maybe a group that does ETFs, a group that does SMAs. You know, the SMA groups tend to have no choice but to find some way to scale using technology, or they just simply can't do their jobs. The the sort of better solutions that I've seen are ones that kind of attempt to float all the boats, something that, technology that can be shared across the firm to make things easier. I mean, and oftentimes this comes to finding the lowest hanging fruit and removing 15 minutes from each trader on the desk's day, right? Whether it's like some form of processing trades automatically, or removing someone from having to type in a ticket manually, or what have you. But a lot of them are either partnering with electronic order management systems, or finding a way to integrate with Bloomberg, or finding a way to integrate with market access.
Thank
Do you
you.
work at market access?
Barely.
Did we work together before? So it's varied in that some of them go all in and build something completely proprietary internally. Some lean on a pre-existing vendor or platform with a heavy integration there to handle the flow. Both are fine. It just depends on what the how much they're willing to invest into the process.
Yeah, just based on discussions, conversations I've had in the past, and kind of equating this with some of the intuition you get with seeing lists every day. I certainly think that firms that are leaning into this are using it as a way to better manage their portfolios on a smaller scale per CUSIP, but huge in size overall. And I don't think it's unreasonable to believe that, given supply and demand dynamics in the marketplace on any given day, may decide to let small pieces of inventory go that in the past would be cumbersome, but could actually be a way to add alpha by taking advantage of better bids in the market, or perhaps proactively getting out of positions as risk may start to turn.
I'm by no means the expert on buy side, but I think it helps to start small, to start with one step. And I think that one thing that some of the most like tech-enabled buy-side firms get right is knowing what they want, regardless of whether it's available for purchase or not. And so if they come into each day and they say, oh, I can buy these 600,000 CUSIPs and I know exactly where they're going to go. Sounds like a daunting task, but if you piece it out kind of step by step, you can get there. And then you're ready to kind of put forth a bid, right? Like if something comes out or take advantage of an offer as soon as it comes out. You can see my sell side bias here. And I think really the most important step to doing that is knowing kind of how much each bond is worth if you want to at least be competitive. Because portfolio optimization is one thing where you can go and you say, I want these features, and I want this rating and this amount. But then if you don't have any expectation of what that's going to cost you, then you don't know if you're, say you have a list of 100,000 bonds to choose from, you might be executing the worst ones in that list. So if you have an expectation of what those will be worth, selling myself a little bit here, but if you have an expectation of what they're going to be worth, you can kind of prioritize kind of the most valuable bonds within that bucket or list, rather.
And I think knowing that valuation in real time, or as real time as possible, is critically important if you're going to use technology, because you're going to want to speed the process. That's what all of us are working towards. And it certainly gives pricing services and other evaluators that have that technology to be able to provide that a competitive edge against others that only report periodically.
Yeah, I mean, I'll talk against myself now. I think more or less, right? Like if it's a really volatile day, yes, real time matters very much. But if right now you're not evaluating the value of an odd lot, for example, like a lot of people use ICE, and that's a round lot evaluation. So how do you know if you're getting a good deal on the odd lot or not? And so if you have any indication of value for an individual bond, I think you're ahead of the curve. But if you want to take it to the next level and start automating execution, then real time makes a little bit more sense. You can kind of execute within bands.
Which goes to another question that came up. How would you go in front to convince a long-only fundamental manager that tech and data is crucial?
I'm happy to take a crack at this one.
Yeah.
If it's available and you're not using it, are you really, I don't want to talk about fiduciary responsibility and all that kind of crap, right? But are you really maximizing the potential return on whatever strategy you have there? I think that, you know, again, in my limited time at Market Access, the amount of data that's out there, right, is overwhelming. It certainly is. But to be able to sort of streamline that or to look through a lens that is specific to your own particular strategy, if you're not doing it, maybe it's working now. I'm of the opinion it ain't going to be working in a couple of years.
Mm.
Candidly, I wouldn't talk to someone who didn't at least appreciate that there could be some value in that. I mean, that's silly.
I'm pretty surprised. One question that came in, and this is near and dear to my heart, I admit. How can we democratize access to our market data? One of the barriers to entry I have heard from many people who looked at the muni market is that the data costs are excruciatingly expensive. And then the next question is, isn't this public data? Shouldn't we be getting this? And my answer is, I think so, but I don't make that rule. But go
I'll
ahead.
happily jump on that first. I've spent a huge part of my career dealing with data, and I mean, honestly, I would say that it's better. It's a lot better than it could be. And the problem is that it's not that as the public you can't access the data. You can. You can't access all of it programmatically all at once. Like, to set up an automated market making machine, I had to purchase all the data so that I have all of it at all times. And yeah, I mean it costs money, but the MSRB, for instance, I think is a really really good example of making data available for pretty cheap. I mean, the consolidated tape is $11,000 a year. It's the cheapest subscription that I have, and I think that's a quite fair price to keep it going. In terms of bond indicative data, that's where you run into it. You can go onto Emma and you can look at any particular one bond that you want by clicking as a general public member, but you can't really build anything programmatic off of that because they'll blacklist you if you try to scrape their website. So, anyways, not that I know.
I was going to say that you have by experience.
So the question is should every member of the United States be able to have access to the entire suite of bond indicative data? Maybe, I don't know. But
Well, I mean, it's public data if it's traded, right? If it's not traded and it's information that you're pulling from your activity every day or yours or from your program, I think there's value to that, and there's a cost to that. If to Chad's point, if you wanted to see individual bond data, Emma's there and it's free.
What about new issuance data? Are you aware if that is publicly available?
I believe that's on Emma as well.
the official statement, and that's actually an interesting point. That's the thing that I think is begging to have, and this is older technology. This isn't really like a generative AI thing. This is more just natural language processing. You find a random OS on Emma and you click on it, and it's like a PDF that's rotated maybe like this much degrees.
There's like a paper clip.
Letters. But there's a business to be made scanning and extracting all of the features and the text out of those things, and I'm sure that's already being done. But
Yeah,
that's where I think there's some room for improvement. And I'm sure the other Matt has plenty to say about this. But
yeah. Well, he and I had talked about this. That's why I raise it here. Is that great once it's posted on Emma, but what about same day? In other words, when it prices that day, should that be posted? Is that public data? I mean, my personal contention is absolutely it should be,
I would agree.
because the bond issuer is the one that's pricing it. It becomes public data the minute it comes through. That's just my 3 cents. Next question. What is the most cost-efficient way to lift and bid odd lot offers from dealers? What protocol should the buy side favor to reduce transaction costs?
I've been talking too much, so I'm going to take a break.
This is to you.
Well,
Jeff, come on.
Yeah,
dig in.
Jeff can start with that.
There's certainly a cost barrier, no matter what platform you're going for. I think the specter of an all-to-all protocol is something that is interesting. I don't think we're really anywhere close to that, just given the nature of the muni market. But certainly, we see participants other than dealers who are active in the market on inventory, to get a better price. And I don't see why, any investor, no matter how big or small, would potentially want to be involved in that. So it's probably far out, but that would be a way to do it.
There's
Go ahead.
cost efficient and then there's efficient. I think, and I'll be a little bit facetious here, so sorry if you asked this question, but the most cost efficient way to lift or bid odd lots is to have a single person who gets runs through email, doesn't pay for Bloomberg, and manually enters the stuff. When you want to automate, like you need to see was it the trees through the forest or the forest through the trees? Whatever. You know what I'm saying. Like the opportunity cost is once you automate, you can do more, you can bring in more revenue, at least on the sell side, you could trade more, right? That the value proposition is very straightforward. On the buy side, you can manage more money with less people, sorry to say it, but that's kind of the way this goes. So there's a cost to efficiency. If once you can make the case for paying that cost to achieve that efficiency, that's a completely different story than I think cost efficiency. Because maybe the right answer is that you go buy everything off of market access programmatically.
By the way, you did say AI before.
Yeah. Eventually, if you take the process that Matt described and get it to the end, you're going to need electronic execution, which means that you're going to need a fixed connection to some platform. And the problem is that they call it the fixed standard, and I complain about this on every panel that I've ever been on. It's not standard at all. Everybody changes it and puts in their own, blah blah blah. That's the problem. Is that you want to find a platform. If you're a buy side, you want to find a platform that has all the dealers that you care about, and there's too much, there's too much variance of where people are, and so you end up finding yourself having to code to 6 platforms, and it takes forever because they're all different. They've implemented even different versions of Fix and different customizations, and the problem is that there is no one place to go to get everything, so you pick one, and you can probably do fine doing that. I'm drawing a blank on what one I would pick, but
I agree with the point that Matt brought up, though, right? It's like there is a cost to it, right? But does that cost, get completely overwhelmed by the P&L you're able to capture by investing in that? So is it a cost or is it an investment? And I don't know, right? And I think it's definitely another subjective question, but I think that's the way you have to look at it, right?
I think it's pretty simple equation, really. Like you look at the marginal cost that it takes to execute trades manually versus how much you're giving up on the platform and how much more trading you're doing by doing that. You can make some very simple assumptions. Say, okay, what if I 2x my trading volume by automating or at least having that same trader maybe just oversee some kind of semi-manual process. If they double their volume, like you can come up with a very succinct formula that says this is better than this. And I do want to say on the democratizing the data front,
Yeah, please.
we're not free by any means, but if you're a startup, there is a company called like FinTech Sandbox or something like that, which it'll give you like free access to data to test with. We're not even part of that. I just saw it one day and thought it was pretty cool. If somebody from FinTech Sandbox watches this, we'll be happy to give you data. That also applies to just talking to vendors. Like this is a relationship-driven market. Everybody wants to be friends with everybody. It's too small to have enemies in munis. And so more like very frequently people will reach out to us and they'll say, hey, can you send us 3 months worth of pricing data? And we say, hell yeah, test it out, do all you want with it and do it for free. And then the second you start realizing some value with that, like let us get a piece of the action. Because it costs money, like you said, to produce our data. Like we have to pay the MSRB, we have to pay reference data, we have to pay headcount, QSIP, yeah. It never ends. It's not a cheap business. A lot of people think it's like a very high margin business. Not yet.
Yeah, that's the barrier to the cost being the barrier to entry for the data with all the little bits and pieces. So can I ask the final question, generative AI now?
Yeah.
Okay. Okay. Good. So generative AI has become an increasingly relevant topic as it pertains to how the world will look in the future. Have your opinions or business strategy regarding Gen AI changed? Is this something you would want to build out further?
Go ahead, Chad.
I'm not starting on.
I have an opinion. I ignored most of that question, even though I wrote it.
Yeah, he wrote it just for the record. That was not mine.
I'm just curious about like if you asked people a year ago, they kind of rolled their eyes, and I think the answer is still kind of a little bit of an eye roll. But I have found the LLMs to be a lot better in terms of like helping people code. So I hope that that's kind of diffused through the market in general. I think coding is just fun. It's like the new kind of Excel. It's not as daunting or as hard as it may seem from the outside. And then also, I'm waiting for somebody to build this. Make like a chat GPT where you say, here's my input data, here's what I'm trying to predict. Try like every single model and tell me which ones performs the best. That's what I want.
I would jump in. I think on the same thread there of you know kind of just getting in there and working with it. The interest of AI is the ability to leverage human thought. We've got plenty of them. So just technologies like a Google came along 10, 20 years ago. It's maybe unfamiliar right now, but to the point you were making, the ability to develop a technology base rapidly accelerates with a technology like this. And I think we're still figuring out what the applications can be. And we're just kind of following the KISS methodology right now of just get involved, because any interaction you have there can be a jumping off point to a great idea that can help you implement a technology solution in the future.
I think that's a great point. I think it exists today, right? It's in its infancy, right? Now, Chad and I joke all the time, when everyone says AI, it's basically like a macro in an Excel spreadsheet. We were talking about how we're going to insert Skynet into this conversation, so I win on that one. But I do think that, where does that take us? I don't know. There's still a context or contextual part of the muni market that, can AI solve, right? We can solve for pricing and we can solve for structure, but can AI then sort of, or, some sort of, programmatic thinking, solve for context within the market? Is it bias? Right? Is that, looking at, some things like seasonal impacts? I'm not quite sure, but I do think that it's there now. It certainly is in its infancy, and it certainly will likely become, more of a, mainstream conversation piece in the near future.
I think Matt made the point that I was going to make, which is that the immediate applications of this are quite general and have nothing to do with munis. It's about generating code and making people able to produce more and better code in a shorter amount of time. Something else like what he described, something that would be smart enough to test out a data set with multiple different models and like all this kind of thing. That's just pure statistics, right? It could help anywhere where you can use data to do something. And so could it help munis? Absolutely. But I think it's still quite general and very cool, but general.
You still need the person. It's a tool.
Mhm.
Like AI is not going to solve for muni problems, and I don't think that's what you're saying. Somebody is going to identify a muni problem, and they might use AI to solve it. I think that's the
Right. Well, we've run to the end of the time, and I will summarize what I think I'm hearing from all three of the panels. Does anybody in the room think the muni market is going to look different 2 years from now, or is it going to look the same? How many people think it's going to look the same? There we go. Point taken. It's going to look dramatically different over the next 2 years. Huge changes are coming. Just as you said, things are in its infancy. Things are being tested. As a quick plug, if you don't know how to code in Python, you absolutely should learn because it is the way of the future.
Yep.
But with that, the muni market really is the way of the future. I close as I started. It is a fantastic time to be in this market. It is just amazing what we're going to be seeing in the next 2 years. Thank you to the panel, right?